holy? I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story, there's trouble in Germany as the banks are dumping assets. We'll answer the question, are the U.S. banks in danger? I'm going to show you the shocking risk underneath the U.S. banking system that the political elites don't even want you to know about. And things for China are getting worse. I'll show you why stimulus there is failing and unlikely to turn the second largest economy around. And speaking of things failing, are housing prices about to crash? I'll show you how the Trump trade could lead to a massive housing correction. And the dollar's on a tear. I'll show you why that's bad news for the global economy. Now let's over to Bloomberg, where we picked today's story up with a headline, as German banks start to cut U.S. office loan exposure that caused the bond turmoil. And that's right, the German banks are dumping U.S. assets. And this is a shock because we already know that many of these commercial real estate buildings have lost a tremendous amount of their value. It wouldn't make sense. Of course, why would you sell at such a loss? Well, the banks in Germany are being forced to. This could lead to U.S. banks picking up even more risk. But wait till you see why the U.S. banks aren't having to sell, and yet the German banks are. As Deutsche Bank AG is close to selling about $1 billion of loans linked to commercial real estate there, and Deutsche Vanderbrief Bank AG is cutting back on office and American loans after it set aside hundreds of millions of euros as a buffer against potential property losses. But the issue isn't about potential losses, is the buildings have lost money, and yet there are these large loans sitting on these properties. And of course, we know these loans are backed by rents, and that is one of course, the staples of the commercial real estate industry is the rents pay the mortgage. Well, the problem here is the hybrid and the work from home, of course, movement has led to rents decreasing, has led to large vacancies inside these buildings, meaning the banks are holding the risk. But why aren't we hearing anything about the U.S. banks? Well, as you're about to see, they're in more danger than you want to realize, as the lender recently agreed to a potential advisory role for a Starwood Property Trust subsidiary on some of its U.S. commercial real estate book, because we're seeing all across the board, well, it's real estate investment trusts, commercial real estate, office buildings, you name it, they're all losing value, and the likelihood that they're going to continue to lose value is extremely high. Potentially, if we head into a recession where more Americans lose their jobs, going to lead, of course, to more offices that are vacant and a collapse in rent that's going to be dangerous for the banks that are holding this risk, and starts to make sense. Why are German banks trying to offload this? Well, we're going to show you why there's bigger problems for the German economy, and they're trying to shed risk as quickly as possible. The sales come as market participants expect the European Central Bank to press German banks to recognize higher losses on American assets. Now, keep in mind, this is a big change that we haven't seen. We know these buildings are losing value because there's transactions that are showing it, yet the banks have not been forced to write down their asset books. And that they did, well, what you'd find out is German banks would be insolvent along with a lot of U.S. banks, but that's going to get covered up. And as we can see, values on the average have fallen by more than 75% from the peak for all but the best U.S. offices. These are notably the newest buildings, and this is dangerous because somebody's holding this risk. Well, the problem is it's the small and mid-sized regional banks here in the United States. But why don't we hear about this? Why isn't there any news about these banks holding loans against assets that have significantly lost value? You'd think, of course, shareholders would want to know, as well as depositors. But price growth declines have resulted in unrealized losses across most vintage periods for office, even loans originating well before the pandemic. And exacerbating the problem, about 1/4 of the country's office space is forecast to be vacant by 2026. So the idea that there's going to be a turnaround here, well, there's no evidence. In fact, there's such a big push by U.S. workers to work from home, even on a partial basis, is going to lead to more vacancies. You're going to see why here. I believe during the next recession, there's going to be a massive push to get people back to work, because you think about all of the businesses that actually exist because of all these office buildings and people commuting and going to work in downtowns and industrial centers. Well, those, of course, businesses are failing. And that's dangerous because it means more jobs likely to be lost. And yet still declining interest rates have boosted optimism that the worst of the decline is over. So that's the belief, well, if we just cut rates a little bit, then, well, everything will be okay. But yet there's absolutely no evidence. In fact, the evidence is otherwise shows that if you cut rates, it means things are going to get worse. Deutsche Bank says the pricing of the loan portfolio is selling, which it didn't disclose, is evidence that the CRE market is stabilizing. They're looking, of course, likely to sell at some sort of a loss. And we talk about all transaction home prices because we don't have a lot of data on commercial real estate. The Federal Reserve database just doesn't have a lot of information on it. But when we look at the federal funds rate shown in red, what we can see as notably when the Fed cuts rates, what happens to home prices? Well, the rate of increase slows. You see that happen here in the 1990s. You see it happen a little bit in the dot-com bubble, but there was a huge demand by boomers for houses. So really the recession didn't slow down the housing market too much. But look what happened during the global financial crisis. You see home price growth slowing, and then the Fed starts to react and cut rates. Home prices lose value, and yet cutting rates didn't stop it at all. We see going into the pandemic, there was a little bit of a slowdown in home price growth, and now we're seeing home price growth slow significantly. The Fed's starting to cut rates. Other central banks are cutting rates, and the belief again, if we just cut 50, maybe 75, maybe 100 basis points, everything will be okay. But history shows otherwise, because what we know is central bankers react to the economy, and when the economy continues to slow, well, it means asset prices likely to decline, and that is dangerous for all of these banks. And now you start to see why the German banks are offloading this as quickly as possible, particularly if the ECB forces this regulations. But when we talk about what really drives home prices lower, there is the demand component, but it also comes out of the banking system, because when we look at the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes, and we compare that to the year-over-year rate of change against home prices for the United States, well, we get a new perspective here, because what you were looking at is if you want asset prices to rise, well, you need the monetary system and the financial system to create the money so consumers and businesses can afford these higher prices. The danger is when you constrict the creation of credit by inverting these yield curves and money curves, which happens when central bankers drive short-term rates up higher than market expectations. Well, what happens then? Banks tighten lending standards, they start to lend less, and that's how money is created in our economy. Without that money injected, well, asset prices have no chance at staying up. And that's really the perspective we get here. We go back to the 1990s. It wasn't the federal funds rate that was falling that was causing the issue. It was the fact that banks had lending standards that were tight. And that's evidenced by that blue line showing above the horizontal black line. There you see home price growth slowing because there wasn't enough new money created to support the housing market. We see that evidence again around 2000. But again, here, demand from consumers was so high, particularly by baby boomers for homes, it really didn't put a big dent in it. But look what happens going to the global financial crisis. We see, of course, this was led by the collapse in mortgage loans. We see financial conditions shot up super tight levels, highest in history. And next thing we know, home prices enter a contraction. Now we see banks tightening lending standards again. We see the slowdown in housing. We see the slowdown in commercial real estate. The slowdown of the economy is all a factor here, and it starts to make perfect sense of why we're seeing what we're seeing here. But the issue again comes back. Why aren't the U.S. banks at risk here? Or are they? And we just don't know it. The market turmoil earlier this year was sparked when the lender, then known as New York Community Bank, slashed dividends to build a bigger loss buffer. Credit provisions at New York Community Bank, now renamed Flagstar Financial, smart move, cover up your losses by changing your name, rose 237% to $947 million. Now, what does that mean? What does credit provisions mean? Well, what they're doing is they're buffering against losses. So think of it this way. When banks lend money and they don't get their money back, well, they have to, of course, pay for those losses from a credit reserve. So they have to take some of their profits, put it into reserves to buffer against that. That's exactly what you're seeing here. And this is dangerous because this rose, again, 237% in the first 9 months of the year compared with the same period in 2023. So what we can see is there was a very clear slowdown in the U.S. economy starting earlier this year. But something that should be rising, that's your trading account. How would you like to trade right alongside with me, know exactly what I'm trading, when I'm trading it? Well, you can do that because I disclose all of my trades. That's right. You want to trade against the machines? This is my favorite report because it gets some very deep signals, and this is called CTA Timer Pro. When machines are in deep short position and we see price moved against it, what happens? It flags a report. Now we have a full back test, so we know the high probability trades, and I review all of them, and I disclose my actual trades to you so you can see what I'm trading. And then we also look at momentum. Now I love this because it's a great validation tool. It also finds some other signals as I'm looking for other trades, and right now we have a great success rate. We've got 83% win rate on our current trades for CTA Timer Pro, 50% win rate. We got a bunch of new trades here, but if you want to trade momentum or you want to trade machine positioning, jump on board right alongside me. You get the daily report, you get the tradable signals, my opinion on all the best trades. We give you the full backtest data so you can check it for yourself. Stop loss levels, full tracking of trades and return, full disclosure on everything I'm trading, a weekly update on everything, a duplicatable system, a 30-day free trial on top of that. Again, jump on board. Links in the description below, because why banks are dumping assets? Well, there's opportunities in this market for you to take advantage of. Because banks in the U.S. responded to the downturn by kicking the can down the road. Now, this is notable. So here you see German banks out on the threat of the ECB forcing them to write down their assets. So what is that telling you about U.S. banks? That they're not being forced to write down their assets, because if they did, and I want you to think about this, the small and mid-sized regional banks here in the U.S., and they cover and hold a large amount of commercial real estate. Now you might think, well, what about the big banks? Don't they carry a lot of these loans? Actually, they don't. It's all done at the small and mid-sized level. The problem here is you force them to write down the entire U.S. banking system from the small and mid-sized bank perspective goes insolvent overnight. And here we can see in an October research paper, and I want you to know that the political elites know what's going on. The New York Federal Reserve staff warned that, quote, banks have extended the maturity of their distressed CRE mortgages coming due and pretended that such credit provision was not as risky to avoid further depleting their capital. So you have this phrase that you might hear, it's called extended pretend. So when you have a loan that you know that, of course, is not going to get paid on, but you don't want to write it down, you don't want to write it off, what you do is you just extend the term. Say, okay, instead of having, 30 years, we'll give you 35 years. And what you hope is that somehow in the middle of this, that lower payment, the extension of the terms, everything will get better and it'll be okay. But here we can see they don't have the money to hold against these loan losses, so they have no choice to extend and pretend. The wall of debt represent a financial stability risk, and yet what do you hear from the Federal Reserve? Well, they're worried about the labor market. They're worried about inflation. What they should be worried about is the banks, because depositors don't know this and shareholders don't know it, and yet there's a massive amount of risk sitting in the U.S. banking system that the German banks see, that the German regulators see, and they want out of it, letting us know that while many people believe it's not possible to see another financial crisis in our lifetime, particularly those being the words of former Fed Chair Janet Yellen, when you look at the U.S. banking system, any further slowdown in the U.S. economy and a further decline in commercial real estate risks setting off a massive financial crisis that'll be centered right around these small and mid-sized banks. Just wait, because things in Germany are getting worse as German industry retreats further as government collapse deepens the crisis. Output dropped 2.5% in a month in September on a seasonally and calendar adjusted basis, nearly offsetting the 2.6% rise in August. So while everyone keeps celebrating any upturn in the data and saying, okay, look, the soft landing is here, the worst is behind us, we keep saying, look, the data does not go down in a straight line. It kind of stair steps down. Hang tight. It's likely to get worse. Here you see that. And what that means is production on a year-over-year rate of change has dwindled to minus 4.6%. The sharp drop indicates that a full recovery isn't yet underway. As we've suggested, it isn't until you turn around the economy and the credit conditions. Things are going to get worse. And in fact, the traditional business model of cheap energy and easily accessible large export markets is no longer working for Germany. And German industrial production remains well behind its pre-pandemic level. In a separate report on Thursday, what we see is exports drop 1.7% in September, narrowing Germany's trade surplus, which now many are starting to say are going to suffer under Donald Trump's second presidency should he impose stringent tariffs. Well, he may not need to, because the economy around the world is weakening. But notably, what's the problem with Germany's economy? Well, it's Chinese demand for German goods. So what do we continue to see all around the world? We see it not just in Europe, not just in Asia, and also here in the US, a decline in demand. And of course, as you see a further decline in demand, that means asset prices are coming down. There's going to see further disinflation and possibly even deflation. We'll get to China here in a moment. And it doesn't require a lot of imagination to see U.S. tariffs on European cars sending the German automotive industry into deeper problems. How about destroy the entire German automotive industry that's already reeling now? It's already in a depression. They just don't want to admit it. But as we talk about economies headed into a depression, it's turned to China. As China price growth, this is their consumer price index, stays near zero as deflation persists. Remember, they just did a whole bunch of stimulus, and what did I tell you? It wasn't going to work. Why? Because they don't even realize that their economy in China is all about the global economy. So when things slow down in the rest of the world, it doesn't matter how much stimulus they do, it's not going to work. The consumer price index rose 0.3% from a year earlier, compared with a 0.4% gain in the previous month. The core, which excludes food and energy, increased 0.2%. But check this out. Producer inflation slid for the 25th straight month with a 2.9% drop on the year. That's a negative in front of that number. And what does that mean? China is exporting deflation. So the fact is, when you look at the Chinese factory sector, where you see producer prices, they're deflating. And that means from a global economy perspective, demand continues to weaken. So if you want to look for a turnaround, well, one place to find it might be in China, but based on what we're seeing in the producer price index, not a chance. And that's one of the reasons why we're going to see further declines in the consumer price index. We go back to this chart. We looked at this the other day. This is a CPI against import prices from all industries in China. Again, both shown on a year-over-year rate of change. And you can see that China, shown in red, as you see a decline in import prices, it puts downward pressure on U.S. consumer prices or keeps them relatively in check. We see right now the Chinese import prices have been negative since 2023, and that is putting further downward pressure on the consumer price index, which many believe under now President-elect Trump will surge higher. I'm not convinced that that's likely to happen. Maybe if we get a whole bunch of tariffs, but again, those don't come online immediately. It does take a while. There is a process that has to go through to get that done. And the persistence of near zero inflation offers the latest evidence that China's domestic demand staying subdued despite Beijing stimulus measures since late September that included interest rate cuts, more cash for bank lending, and support for stocks and property markets. But here's the key. It's about consumers. And look, none of those things. Let's go back and look here. If you talk about supporting the consumer, how does interest rate cuts work? Well, it didn't. How about more cash for bank lending? Well, if consumers don't want to borrow, then giving rate cuts and more cash to banks doesn't work. How about supporting the stock market? That doesn't cause people to go spend. And what about the property markets? Well, we know if the Chinese property market goes well, their banks are insolvent due to all the money they've lent to it. And it just goes to show that when you talk about stimulus and policymakers, they don't understand. In the end of the day, it's all about consumers. It's about their confidence. It's about their incomes. You get confidence to go up along with their incomes, you'll see spending go up. Mark my word. As Chinese authorities have struggled to boost household spending after a years-long real estate slump and weak job market. There's some key words. Weak job market, hollowed out confidence. And again, you want people to spend, give them jobs, and give them jobs that pay well, and they'll go out and spend. And so, again, you come back to China here and their policymakers, they can't understand why they're still dealing with disinflation and deflation. Then, of course, at the producer level, it's because consumers aren't confident, because the job market is weak. And falling producer prices are also squeezing companies' profits and making them reluctant to invest. Well, why wouldn't they? There's no need. There's no demand. An entrenched cycle of price decreases risks holding consumers back from spending. But reality is they don't have a lot of money to spend anyways, in anticipation that goods will be cheaper in the future. And again, we talk about U.S. data here and why the labor market is so important, why accurate data in the labor market is so important. We look at the unemployment rate in red against real retail sales. That's inflation adjusted, shown in blue on a year-over-year rate rate of change. And what do you see? Periods where the unemployment rate is not falling. Well, that leads to a decline in real retail sales. You see rising unemployment. Well, no doubt, as people hit the unemployment line, have less income and less confidence, well, they spend less. You see that relationship happen over and over. And we go back to 2022, where we start to see the bottoming of the unemployment rate as it starts to move higher. What happens? Real retail sales, again, on an inflation-adjusted basis, they go negative and they stay there. This is dangerous because if there isn't a turnaround in the economy, well, that means more U.S. workers likely to hit the unemployment line. We're going to see further declines in factory demand, further declines in the retail side for employment. And what that means then is the U.S. economy isn't in the early stages of an expansion. It validates we're in the early stages of a globally synchronized recession here. But what about the housing market? Well, many people believe it's going to boom, but the challenge is, could under President-elect Trump, we actually see a decline in housing prices? Well, this is one case that Trump trade isn't good news. As America's prospective home buyers absorb harsh reality as mortgage rates probably aren't coming down for a while, a combination of better than expected growth and uncertainty about the impact of President-elect Donald Trump's economic proposals, especially on inflation and the deficit, are combining to keep rates elevated. Again, long-term rates are a function of growth and inflation expectations, not so much the federal funds rate. Now, when the funds rate does go down, well, it's a sign that the Fed is panicking and growth and inflation expectations are falling. But notably, the first few cuts the Fed makes really doesn't impact the long end of the curve a whole lot. And we can look at here as we see the 30-year fixed mortgage rate against the federal funds rate, and we can see as the Fed cuts, well, you don't see an immediate reaction sometimes from long-term rates. And you notice that here right around the dot-com bubble. They didn't react immediately to the Fed cutting rates. You particularly did not see that going into the global financial crisis, where it took several cuts by the Fed before it transmitted into the long end of the curve. And now what we're seeing is a massive topping pattern in yields, suggesting we're going to see a big collapse here. The Fed's going to further cut. And of course, that means the dollar likely signaling liquidity crisis, as jumps on the dollar are now driving it even higher. And it's confirmation that Trump's platform, and he'll aggressively pursue trade policies. And when you do that, well, of course, we know that dollars are created through global trade. So what the dollar is reacting to is the fact that not only is the likeliness that global trade's going to contract here, but there's also a secondary issue. There's a massive dollar shortage. The financial system isn't creating enough. And if dollar continues to rally here, well, it's a dangerous sign, because it tells you we're about to have a massive number of currency crises all over the world. And when you now understand that German banks are dumping assets and the U.S. banks are sitting on a lot of risk, well, you can only then come to the conclusion that at some point we're likely to be knee-deep in the next global financial crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.